Business, wealth and strategy, where smart entrepreneurs build lasting wealth. Government finances affect every aspect of your life. Governments fund our schools, hospitals, pensions, benefits and infrastructure. But behind the headlines about taxes and budgets lies a complex system of borrowing, spending and policy juggling. Right now, the UK government is under intense pressure. Debt is rising, interest rates remain high, and speculation is growing that Britain may even need IMF help, echoing the 1976 bailout. So how do government finances really work? And what impact does it have on you? My name is Karen Newton. I'm a business and wealth strategist. So let's see what we're going to look at today. Government funding sources, high interest rates, QE/QT, budget squeeze, and the IMF fears. So how do governments raise money? Well, just like you and me, just any household budget, the government has to balance income with spending. And it does this through taxes. Now, the backbone of the public finance is income tax, VAT, corporation, national insurance, inheritance tax, car taxes. There's a lot of them. And they borrow money through gilts bonds on the open market when taxes don't cover spending. And I'm going to look as well at quantitative easing, because for much of the past 15 years, the Bank of England brought the gilts to keep borrowing costs down. But in a recent Bank of England meeting, they decided they were going to transition from quantitative easing to quantitative tightening. So from QE to QT. And that is going to affect the government. It's going to make them more accountable for their budgets. Now, when borrowing is cheap and balancing the books is easier, and we know that if mortgages are high, it takes a lot more of our money. But when mortgages are cheaper, we feel a bit richer. We have a bit more money in our hands. But when the government borrows heavily in a high rate environment, that impact is severe. For individuals, it means your mortgage and your loan costs rise. That cuts into your everyday spending budgets. Savers may benefit if banks pass that on, but let's be frank, very few banks actually do that. For the government, servicing the debts becomes far more expensive. And with current national debt at 96% of GDP, the UK's annual interest bill already exceeds 100 billion. And every uptick in rates adds billions to how much it has to pay. And the more it pays in interest, the less it actually has for spending. It's like a cycle where they're having to just pay off loans, borrow more, pay off, borrow more. It's like Peter borrowing from Peter to pay Paul. Now, quantitative easing is what the Bank of England have actually been doing for the past 15 years. And that meant that the Bank of England acted as a guaranteed buyer of government debt. So this safety net helped to keep borrowing costs lower than they otherwise would have been. So with quantitative easing, the bank bought the gilts, the bonds, demand would rise, yields would fall, and borrowing was cheaper. Now, The Bank of England have decided that they are switching to quantitative tightening, that's QT. So that means that the Bank of England is now going to be selling the gilts that it has or letting them mature. And that means that demand is going to fall and yields will actually rise and borrowing costs will climb. So why did the Bank of England have this policy shift? Well, QE, quantitative easing, was an emergency medicine, if you like. It was introduced after the 2008 financial crisis. Remember that in 2008, we just had this huge financial crunch and money just dried up. Nobody trusted anybody. There was no movement of funds anywhere. And the bank was pumping money into the economy to try and keep cash flowing. And it expanded this during the pandemic. Now, QE helped liquidity, but it inflated asset prices and created long-term distortions. And the Bank of England doesn't want to be in the position where it's holding 800 billion plus of gilts. So it wants to transition into QT, which normalizes the markets. And it means that if the Bank of England is consistently in emergency mode, so it's always operating under QE, when there is an actual emergency, it has nothing in reserve. So the Bank of England needs to move the way it operates and normalize the markets again. So QE was an inflation control. It injected money into the system, whereas QT, quantitative tightening, withdraws money out of the system. So even if gilt yields rise, money supply shrinks, and this eases medium-term inflation pressure. Now, fiscal discipline by force. Because quantitative easing allowed governments to borrow without any real consequences. However, quantitative tightening makes overspending painful. It's forcing discipline and it reduces future inflation risks. And the fourth reason that the Bank of England has changed its policy from QE to QT is credibility with investors. The Bank of England must show independence. So it has to show that the government isn't dictating policy to it, that it is managing the finances of the country and the inflation. So continuing quantitative easing looks like it's financing the government, whereas quantitative tightening reassures investors and helps protect the price of the pound. So it produces short-term pain for long-term gain. And yes, QT raises the costs today, but it restores balance, it reins in inflation, and it preserves market trust. But there's an immediate fallout, and it's painful for both government and citizens because debt servicing costs soar. That requires more revenue via higher taxes and stricter spending. There's less room for manoeuvre because it limits the tax cuts or major new spending plans. It has a reliance on investors, so global buyers demand higher returns. And there's a risk if the markets panic, the pound falls and borrowing spirals. Now, the ripple effects of this is that the government's already raised taxes to record levels, yet faces widening gaps. The budget gap, the borrowing since April has it's estimated to be around 42.8 billion, despite slightly lower numbers in July. So the autumn budget pressure, the OBR estimates, that's the Office of Budget Responsibility, estimates there's just 9.9 billion headroom against fiscal rules. And it's forecasting that the government could be facing up to a 50 billion shortfall in funding. So the ripple effect for that is tax speculation. And that means there's likely options are going to include stealth taxes, frozen thresholds, pension changes, property and wealth levies. We've already seen in the headlines all the different speculation that's going on out there as the government tries to find ways to balance the books. Now, there's also the risk that the high borrowing costs are paralleling those of 1976, and that was when the IMF was required to bail out the UK. So even if IMF support, which is unlikely, it could happen, but the probability is not that high at the moment, the comparison weakens investor confidence. So government finances may feel a bit distant, and you may think, oh, there's all this politics going on about this. It doesn't affect me. I don't want to know what is happening. But the government finances impacts you daily. It directly affects the money that's in your wallet. It creates high interest rates and budget pressures, and they are shaping tomorrow's taxes, pensions, and services. How do they affect you personally? Well, if the government has strong finances, that means stable taxes, reliable public services, and we can live our everyday lives realizing that we do not have to stress over how we're going to pay all the bills. When finances are weak, especially when borrowing costs rise, this leads to higher taxes, reduced spending on infrastructure, and more expensive day-to-day living costs for us. So what can you personally do? Well, whether you have £1 in the bank or you have £1 million in the bank, there are steps you can take to protect your finances. And those steps are to become your own economist. Look beyond the headlines and understand how QE and QT affect your mortgage, your pensions, your taxes. Be your own advocate. Hold your MPs, so the policymakers, to account. Get those explanations on debt and spending and promises. And be your own strategist. Plan for stealth tax rises, frozen allowances and benefit cuts, and adjust your personal wealth strategy early. Now, if you want to learn more about how to manage your finances, future-proof your income, build investments and wealth, I have a course which is called Zero to Millionaire. It's a membership, and we cover practical business and wealth strategies so that you can keep more money in your pocket no matter what the economy is doing. And I'll put the link below.